legally speaking, the exact moment a farmer, well, anyone, really takes an apple from their orchard and, smashes it into a jar to make apple butter, they instantly stop being a farmer.
Right.
In the eyes of the law, they just became a commercial manufacturing factory.
Yeah, the transition from like raw earth to a packaged good is just a massive legal minefield.
Welcome to the deep dive.
Thanks for having me.
So today, for you listening, we are opening up a stack of technical sources detailing the surprisingly intense, fiercely complicated world of farm liability insurance.
It is surprisingly intense.
It really is. Our mission today is to decode these hidden boundaries of agricultural risk. Because, we carry around this deeply ingrained, picturesque idea of what a farm is.
Right, the red barn, the green tractor, the quiet fields.
Exactly. But when you look at the actual legal and financial architecture keeping that property afloat, that simple painting is just completely ripped to shreds. The farms you drive past are not just fields of dirt.
No, not at all. They are complex hybrids. They're private homes, heavy industrial work sites, and retail businesses, all operating simultaneously on a single plot of land.
And that hybrid nature is really the core of the problem for anyone trying to insure these properties.
Oh, absolutely. Because a farmer's business and their home are frequently located on the exact same premises.
Right.
So you can't just hand them a standard homeowner's insurance policy because, they have a $500,000 combine harvester parked next to the family minivan.
Yeah, that doesn't quite fit standard coverage.
Exactly. But you also can't just give them a standard commercial policy because their kids are sleeping 50 feet from the commercial storage silos.
So they need a totally different approach.
Right. They require a highly unique safety net. And usually this means combining farm property coverage with a standalone liability policy, sometimes called a monoline policy, to create this massive comprehensive package that covers all those overlapping exposures.
Okay, so to really understand how this specialized safety net works, we first have to figure out where the quote-unquote farm actually ends and where the commercial factory begins.
The apple versus apple butter dilemma.
Exactly. It feels a bit like baking cookies. Like if I bake a batch of cookies in my home kitchen, it's just a hobby.
Right.
But if I start scaling up, buying industrial mixers and selling them nationwide, I'm suddenly a corporation subject to totally different regulations.
For sure.
So with farming, how strict is that boundary line? Is it really as simple as smashing an apple?
It actually is. The legal definition of farming in these documents is remarkably strict. Our sources define farming as the operation of an agricultural enterprise.
Okay.
And crucially, that definition extends to include the operation of roadside stands on the farm premises.
So you can have a stand.
You can. However, there is a legally binding caveat attached to that. Those roadside stands must be maintained solely for the sale of farm products produced principally by the insured farmer.
Okay, let's test that boundary with a real-world scenario from the text. We have Farmer Jack.
Good old Jack.
Jack grows apples. He sets up a wooden stand at the entrance to his driveway, sells a basket of his raw, freshly picked apples, and unfortunately a customer takes a bite, gets incredibly sick, and decides to sue him for damages.
Well, in that specific instance, Farmer Jack is fully protected.
Oh, yes.
Yeah. His standard farm liability policy completely covers his product's liability. And the logic there rests on two pillars. One, he grew the raw agricultural product himself.
Right.
And two, he sold that raw product on his own physical property. He is operating safely inside the traditional definition of farming.
Okay, but let's say Jack wants to increase his profit margins.
As one does.
Right. He takes those exact same apples, cooks them down on his stove, adds some cinnamon, and jars them as apple butter to sell at the exact same roadside stand.
Yeah, well, he has just crossed an invisible legal boundary into secondary processing.
Just by cooking them.
Just by cooking them. The raw agricultural product has been fundamentally physically altered. When you introduce manufacturing, cooking, canning, adding ingredients, you introduce completely new risks to the public, like improper sterilization or botulism.
Oh, wow.
Yeah, and a standard farm policy is not priced or designed to cover manufacturing hazards. So to sell that apple butter, Jack is now legally required to carry the product's liability coverage of a CGL, a commercial general liability policy.
Wait, really? Just for apple butter?
Just for apple butter. If that apple butter makes a customer ill, his basic farm policy will not pay a single dime to defend him.
That is wild. So the physical act of altering the crop changes his entire risk profile.
Exactly.
What if he tries a loophole, though? What if Jack doesn't cook them, but he harvests his apples, puts them in a truck, drives them to a facility down the street to be washed, sorted, and put into plastic retail clamshells, and then brings them back to his own roadside stand to sell.
So he didn't alter the apple itself?
Right, he just processed it off-site.
The geographic boundary is just as strict as the physical state of the product. Processing your products off the premises, even if the finished item returns to the home farm for sale, instantly pushes you into commercial liability territory.
Wow.
Yeah, and the sources list several other triggers too. If you start wholesaling your products or, distributing them to local grocery stores or engaging in any retail operations beyond that simple on-premises roadside stand, you are operating a commercial enterprise.
So mail delivery would count too then?
Oh, absolutely. Even packaging your crops for direct-to-consumer mail delivery pushes you out of the simple farming definition.
So for a modern farmer trying to survive by selling homemade jams at the farm stand while also shipping boxes of produce to local restaurants, they're essentially forced to carry both a farm liability policy and a CGL policy simultaneously.
Yeah. They have to constantly straddle that line. The transition from the soil to the consumer is really a legal gauntlet.
Okay, so if a farmer manages to stay safely within those strict boundaries of agricultural work, we need to look at how this safety net actually functions when things inevitably go wrong.
Right. The actual mechanics of the payouts.
Exactly. The texts break the liability payouts down into what looks like an alphabet soup of insuring agreements. Specifically, we've got coverages H, I, and J.
Yeah, and before we analyze the mechanics of those coverages, the source material offers a great piece of trivia regarding why they're lettered that way.
Oh, yeah, I saw this.
Yeah. Liability coverages in these policies always start with the letter H.
Which seems completely counterintuitive. I mean, why start a list at the 8th letter of the alphabet?
Because the majority of farmers purchase their liability policy as part of a larger bundled package with their farm property form.
Oh, okay.
And the property form, which covers the physical barns, the tractors, the house, has already reserved insuring agreements A through G. So the liability side simply picks up the alphabet right where the property side leaves off.
Okay, that makes perfect structural sense.
Mm.
So let's look at the first liability agreement, coverage H.
So coverage H is the core farm liability layer. This provides coverage up to the policy limit for bodily injury or property damage to others that the insured is legally obligated to pay.
So this is the fortress.
Exactly.
Yeah.
This is the fortress. If a customer is injured by a tractor or gets sick from a raw apple at the roadside stand and they successfully sue the farmer in court, coverage H is the mechanism that pays out the court-ordered damages and covers the legal defense fees.
Got it. Then we have coverage I, which is personal and advertising injury. This one is fascinating to me because it moves entirely away from physical harm to a person or a piece of property.
Right. It's totally different.
It pays for injuries committed against a third party involving things like libel, slander, invasion of privacy, copyright infringement, and misappropriation of advertising ideas.
Which is super important because the farming industry is incredibly competitive and marketing has become vital to survival. Imagine a scenario where Farmer Jack starts running an aggressive local ad campaign. He puts up billboards claiming his organic apples are pure, but strongly implies the farm across the street sprays toxic sludge on their crops.
Oh, wow.
And then the neighbor loses business and sues Jack for slander and defamation. Coverage I is the mechanism that provides Jack's legal defense for his business communications.
Okay, so that's H and I. Then we arrive at coverage J, which is medical payments. The text says this policy pays for reasonable medical expenses incurred within 3 years from the date of an accident or injury.
Mm-hmm.
But the standout detail here is that it pays regardless of whether or not the farmer was actually at fault for the accident.
Yeah. The interaction between coverage J and coverage H is honestly one of the most brilliant psychological tools in the insurance industry.
Let's puzzle through this because the dynamic seems almost contradictory to me.
Has-
Well, the source gives a scenario. A customer named Terry stops at Farmer Bill's roadside stand. An apple is rolled out of a basket and is sitting in the walkway. Carrie steps on it, slips, and breaks her arm.
Right.
According to the text, coverage J will instantly pay Terry's emergency room bills, no questions asked, without assigning any legal blame to Farmer Bill.
Exactly.
But coverage H, the main liability fortress, only pays out if Terry actually hires a lawyer, takes Farmer Bill to court for negligence, and wins a judgment.
Yep, that's correct.
So why does the insurance company offer both? Is coverage J basically designed as a strategic buffer, like to prevent lawsuits?
You nailed it. It is a deliberate, highly calculated de-escalation mechanism. Think about it. When someone gets injured on a property, the primary drivers of massive multi-million-dollar lawsuits are anger and immediate financial panic.
That makes sense.
Terry is sitting in the emergency room staring at a $3,000 medical bill she can't afford. If the insurance company forces her to prove it was Farmer Bill's fault before they pay a dime, her only option is to hire a personal injury lawyer.
And once a lawyer is involved.
Exactly. Once a lawyer is involved, they aren't just suing for the $3,000 medical bill. They're suing for pain, suffering, lost wages, and negligence, potentially costing the insurer hundreds of thousands of dollars.
Wow. So Coverage J is basically the financial olive branch.
Yes.
The insurer is essentially saying, look, we don't care whose fault it was. Let us just pay your hospital bill right now, today, so you don't panic, you don't get angry, and we can all walk away.
It is a strategic minor loss designed to prevent a catastrophic one. It keeps the dispute entirely out of the courtroom. If Terry takes the olive branch, everyone moves on.
And if she refuses?
If she refuses and decides to sue anyway, then Coverage H steps in, the olive branch is retracted, and the legal battle begins.
That is fascinating. So H, I, and J provide a very robust safety net as long as everyone and everything stays on the farm. But a farm isn't a sealed environment. Heavy equipment has to move.
Right.
We have to look at the exclusions, so specific scenarios where the insurance company flat out refuses to pay.
Yeah, and the standard farm liability form carries exclusions very similar to a standard commercial policy. The insurer will not cover losses arising from expected or intended injuries.
Makes sense.
They exclude damage caused by pollutants. They exclude motor vehicles registered for highway use and aircraft, which is particularly relevant when you factor in the massive liability of crop dusting.
Oh, sure.
And they also exclude damage to the insured's own products.
But the exclusion that really stands out in the stack of sources is the one regarding quote-unquote custom farming.
Yes, the custom farming exclusion.
The policy entirely excludes bodily injury or property damage liability arising from the farmer performing custom farming operations for others. But there is very specific financial threshold attached to it.
There is.
The policy defines custom farming as work performed for others under a contract, but it exempts the farmer's first $5,000 in receipts in any 12-month period.
Right.
Why such an incredibly low number? I mean, in the world of industrial agriculture, where a single replacement part for a combine can cost $5,000, that threshold seems almost meaningless.
It sounds ridiculously low, I know. But the $5,000 threshold is actually a profound reflection of agricultural culture.
How so?
Well, the insurance companies recognize that farming relies heavily on a deeply ingrained system of neighborly help. If a massive storm is rolling in and the farm next door is behind on their harvest, it's just expected that you will jump on your tractor, drive over to their property, and help them pull their crops out of the ground.
Oh, wow, okay.
Insurers don't want to penalize that casual mutual aid. The $5,000 allowance is a cultural buffer.
So it's essentially the favor for a neighbor limit.
Exactly. It's the favor for a neighbor limit. But the moment you start generating more than $5,000 a year, taking your equipment onto other people's property, you're no longer just doing favors.
Right.
You have established a secondary commercial contracting business. The risk profile skyrockets.
The source gives a great example of this. We have farmer Joe. Joe signs a contract to harvest crops for a neighboring corporate farm for $10,000 a year.
So he is well over the cultural buffer.
Right. While driving his massive tractor on the neighbor's land, Joe accidentally throws it into reverse and crushes the supply truck making a delivery.
Oh, no.
Without a specific addition to his policy, Joe is entirely personally liable for that destruction.
Yeah. To survive that scenario, Joe must proactively purchase and attach the custom farming endorsement to his policy. This endorsement specifically buys back the coverage for that contract work.
Oh, wow.
But what makes this endorsement structurally fascinating is how it alters another standard exclusion in the policy.
Which one?
Normally, liability insurance will not pay for damage to property that is in your care, custody, or control. If you are hired to fix a laptop and you accidentally drop it, your liability insurance won't cover it because you had custody of the item you were working on.
So if Joe is hired to harvest the neighbor's wheat field, and a spark from his tractor burns the entire wheat field down, a standard policy would say, sorry, that field was in your care and control while you were harvesting it. We aren't paying.
Which would bankrupt Farmer Joe instantly. But the custom farming endorsement uniquely overrides that restriction. It removes the care, custody, or control exclusion entirely while the farmer is performing the contracted work.
Wow.
It ensures Joe is protected against the massive risks of operating heavy machinery on someone else's livelihood.
Okay, so operating on a neighbor's property is incredibly risky. But the risks inherent to a farmer's own land present an entirely different liability puzzle,
That's familiar.
specifically the people running the farm and the environmental impact of the farm itself. The sources detail a series of endorsements designed to patch up the massive holes left by the standard exclusions.
Let's examine the human element first. The standard policy excludes injuries to farm employees. To cover their workforce, a farmer needs the farm employer's liability endorsement. This mechanism functions by combining the employer's liability coverage, typically found in a workers' compensation policy, with the medical payments coverage we discussed earlier. It pays for bodily injuries sustained by an employee that arise directly out of their duties on the farm.
And the source notes a crucial optional extension for this endorsement regarding vehicles and watercraft. It covers medical expenses if an employee crashes a farm vehicle, as long as the accident occurred while they were acting within the scope of their normal duties.
Exactly.
But if we want to talk about the truly terrifying risks on a farm, the risks that keep actuaries up at night, we have to look at the limited farm pollution extension.
Oh, yeah. Pollution is the ultimate invisible threat.
Yeah.
The main farm liability form entirely excludes any damage caused by the release of pollutants, whether that's toxic fertilizer runoff, pesticide drift, or fuel spills. The limited farm pollution extension allows the farmer to buy back a small fraction of that coverage for incidents that happen on their premises.
But the caveats attached to this buyback are just fascinating.
They are very strict.
The source explicitly states that this endorsement entirely excludes pollution damage originating from any storage tank, container, duct, or piping that is below or partially below the surface of the ground or water.
Right.
It also flat out ignores any pollution cleanup costs ordered by a governmental authority. So basically, if the risk is buried out of sight, the insurer absolutely refuses to touch it.
Not a chance. If you look at the mechanics of how insurance companies price risk, that hardline exclusion makes ruthless financial sense.
How so?
Insurers operate on calculable probabilities. If an above-ground diesel tank springs a leak, the farmer sees the puddle, smells the fuel, and mitigates the problem in an afternoon. The damage is contained and easily quantified.
Right, you can see it.
An underground pipe, however, is a mystery. A subterranean fertilizer line might leak a slow, steady drip of toxic chemicals into the local town's water aquifer for 15 years before anyone notices a change in the water quality.
Oh my gosh. And the scope of that disaster is practically infinite. It could sicken a whole town, and the cleanup costs would be astronomical.
Exactly. You can't put a premium price on a risk you can't even see happening. Insurers want absolutely no part of an unquantifiable, invisible disaster. They leave the underground completely uninsured.
And the financial fallout of an environmental disaster brings us to another major structural reality of modern agriculture, which is who actually owns the dirt.
Yes.
The solitary, independent family farmer working their own isolated plot of land is largely a myth today. The sources detail the additional insured endorsement, which reveals an incredibly vast, interconnected web of ownership and liability.
Modern farming is a deeply integrated corporate endeavor. A single farm's operations might rely on dozens of separate financial entities. The additional insured endorsement allows the primary farmer to extend the protective umbrella of their liability coverage to a massive list of stakeholders.
And the list in the source text is staggering.
It goes on and on.
It allows the farmer to extend coverage to the person or organization they lease the land from. It covers the real estate manager. It covers independent contractors hired to manage the daily operations. It extends to the companies leasing the massive tractors and combines to the farmer.
Yep.
It covers the vendors and distributors who take the final product to market. It even covers non-resident relatives who hold a financial stake in the family business but live in a different state.
To understand the necessity of this endorsement, you have to trace the mechanism of a lawsuit.
Okay.
If a batch of contaminated crops leaves the farm and causes a massive outbreak of illness across multiple states, the victim's lawyers do not just sue the farmer, they sue every single entity in the supply chain. They sue the grocery store vendor who sold it, they sue the distributor who trucked it, they sue the real estate holding company that owns the dirt it was grown in.
So the additional insured endorsement creates a unified legal defense. It ensures that the farmer's insurance policy steps up to defend the vendor, the lessor, and the distributor, because without those partners, the farm couldn't exist in the first place.
The farm relies on the network to survive, so the farm's insurance must protect the network.
We've spent this deep dive exploring the traditional hazards of agriculture, contaminated crops, multi-ton tractors, environmental runoff. But the reality of modern farming is rapidly changing.
It really is.
To survive economically, many farmers have had to completely pivot their business models. They are turning their acreage into literal tourist destinations, and in doing so, they completely shatter their traditional liability profile.
The undeniable rise of agritourism has forced the insurance industry to invent highly specific endorsements for non-traditional farm income. And the primary tool used to manage this shift is the business activities liability endorsement.
Oh, yeah.
This mechanism allows farmers to legally rent out portions of their insured location to the public for commercial events.
Which makes sense. The texts note that farms are renting their barns out for high-end weddings, hosting birthday parties, offering horseback riding lessons, operating corn mazes.
Right. They are no longer just selling a crop. They were selling an experience.
But the fine print on this business activities endorsement includes some incredibly specific and frankly bizarre exclusions.
Oh, yeah.
For instance, it explicitly excludes bodily injury of residents' employees. But the one that stops you in your tracks is that it explicitly excludes any liability arising from corporal punishment administered by or at the direction of the insured.
Yeah, that one stands out.
Why on earth does a modern business policy need a specific clause stating they won't cover you if you physically strike someone?
It sounds archaic, but it is a direct legal holdover from the history of farm property laws. Historically, farm liability grew out of basic homeowner policies. And early agricultural labor often relied on the farmer's own children, extended family, or local apprentices living on the property. In earlier eras, the legal boundaries regarding the physical discipline of apprentices or family farmhands were pretty murky. Today, the insurance industry leaves zero room for ambiguity. They explicitly carve out corporal punishment to guarantee they will never be forced to pay legal defense fees for a farmer who strikes an employee or a guest.
That makes historical sense, even if it's shocking to read on a modern form. Another major exclusion on that endorsement is liquor liability.
Right, which is huge for agritourism.
If you are hosting a wedding, alcohol is almost certainly involved. But the source causally mentions that a farmer can buy back the liquor liability coverage by literally just checking a box on the front of the form.
Yep, just check the box.
Between checking a single box to serve whiskey at a barn wedding and the final endorsements mentioned in the text, it sounds less like a working agricultural enterprise and more like a rural amusement park.
It really does. The final two endorsements in our sources perfectly illustrate how far the definition of farming has stretched.
Let's hear them.
You have the animal rides for profit or charity endorsement, which provides bodily injury and medical payments coverage when livestock are used to give rides to the public for a fee.
Okay.
And then you have the animals in contests or stunting activities endorsement.
Wait, stunting activity.
Stunting activities. This provides coverage when the insured's livestock are used in practice or preparation for prearranged racing, strength contests, or stunting events.
We have gone from growing apples to coordinating stunts.
The identity of a modern farmer is completely fluid now. Economic pressure requires diversification. A person might be a traditional cultivator of corn on a Monday morning. By Friday night, they are a high-end hospitality manager running a wedding venue with a liquor license.
And on Saturday afternoon, they're coordinating a charity rodeo featuring stunting horses.
Exactly. The insurance industry is forced to use these incredibly precise niche endorsements to adapt 19th century property concepts to the 21st century gig economy of farming.
We have covered a massive amount of ground today. I think the biggest takeaway for you listening is that the next time you drive down a rural highway and pass a quaint little wooden farm stand, you aren't just looking at a basket of apples.
Not at all.
You are looking at a meticulously balanced ecosystem of liability, of unquantifiable environmental risk, and fiercely guarded legal definitions.
Which leaves us with a final, rather profound question about where the system goes next.
Oh?
If we apply the strict legal logic from our sources, the idea that the simple physical act of mashing an apple into apple butter fundamentally breaks the legal definition of agriculture and shifts the farm into commercial manufacturing, we have to wonder how this century-old insurance model will survive the next wave of technology.
Or the boundary lines are going to completely disintegrate.
Imagine the near future of agriculture. We are already seeing the development of on-farm AI robotic processing. We are moving toward a reality where machines could theoretically 3D print synthetic or heavily altered food products straight from the raw harvest, right there in the middle of the field.
Wow.
When the line between growing a raw crop and manufacturing a highly processed consumer good disappears entirely on a cellular level, how will an insurance policy ever define what a farm actually is?
Right now, a jar of apple butter is the legal boundary line.
Yeah.
But tomorrow, the entire concept of farming might need to be rewritten from scratch. We will leave you to ponder that one. Until next time, thanks for taking the deep dive.